Amazon just reported third quarter 2025 earnings. Revenue hit $180 billion. Operating income came in flat year over year at $17.4 billion, but there's more beneath the surface. A $2.5 billion FTC settlement, $1.8 billion in severance costs, and a massive infrastructure spending spree. Let's break down what's really happening with Amazon's business right now. Amazon's net sales grew 13% year over year to $180 billion in Q3. That beat expectations. For the 9 months ending September, revenue reached $503.5 billion, up 12%. North America grew 11% to $106 billion. International grew 14% to $40.9 billion, though currency tailwinds added $1.5 billion. AWS, the cloud business, grew 20% to $33 billion. The growth is solid across all segments, but AWS continues to be the crown jewel with the highest growth rate and margins. Operating income stayed flat at $17.4 billion. But here's the context. Amazon took a $2.5 billion charge for settling a lawsuit with the Federal Trade Commission. They also recorded $1.8 billion in severance costs related to planned job cuts. Without these one-time items, operating income would have been roughly $4.3 billion higher. For the 9-month period, operating income was $55 billion, up 16% year over year. North America generated $18 billion in operating income. International delivered $3.7 billion. AWS produced $33 billion, representing 60% of total operating income, despite being only 19% of revenue. North America is Amazon's largest segment at 59% of revenue. Sales hit $106 billion, up 11%. Operating income dropped to $4.8 billion from $5.7 billion last year. The decline is entirely due to the FTC settlement and severance charges, which both hit this segment hardest. Operating margin fell from 5.9% to 4.5%. The business fundamentals remain strong. Unit sales continue growing. Prime membership and fast shipping drive customer loyalty. Advertising revenue keeps climbing. International sales reached $40.9 billion, up 14%. Strip out foreign exchange gains and growth was 10%. Operating income declined slightly to $1.2 billion from $1.3 billion. Operating margin compressed from 3.6% to 2.9%. Severance costs hit this segment too. The business grew across major markets. Europe and Japan showed strength. India continues expanding despite regulatory complexity. The segment remains subscale compared to North America, but the trajectory is positive. AWS generated $33 billion in revenue, up 20%. Operating income grew 9% to $11.4 billion. Operating margin contracted from 38% to 35%. Why? Massive infrastructure spending. Amazon is investing heavily in data centers and AI capabilities. Capital expenditures for AWS jumped significantly. Technology and infrastructure costs surged 30% for the company overall, driven primarily by AWS investments. The margin compression is a deliberate choice to capture AI workload growth. AWS remains incredibly profitable and is funding Amazon's future. Cost of sales increased 10% to $88.7 billion. That's 49.2% of revenue, improving from 51%. Better operational efficiency despite higher volume. Fulfillment costs rose 12% to $27.7 billion. Technology and infrastructure exploded 30% to $29 billion. This line item now represents 16% of revenue, up from 14%. Sales and marketing grew 10% to $11.7 billion. The cost surge in technology is the big story. Amazon changed depreciation assumptions for servers, moving from 6 to 5-year useful lives. This added nearly $400 million in quarterly depreciation expense. Operating cash flow hit $85 billion for the 9 months, up 21%. That's strong. Capital expenditures totaled $90 billion, up 74%. Free cash flow turned dramatically negative. Trailing 12 months free cash flow was just $14.8 billion, down 69% from $47.7 billion last year. Amazon is burning cash building infrastructure. Property and equipment purchases reached $115 billion for the trailing 12 months. The majority goes to AWS data centers. Finance leases added another $2 billion. This is the most aggressive investment cycle Amazon has ever undertaken. Cash and marketable securities totaled $94 billion at quarter end, down from $101 billion at year end. Still substantial. Total debt stands at $50.7 billion. Net debt is minimal given the cash position. Current ratio is 1.0, down from 1.1. Not ideal, but manageable. The balance sheet remains fortress-like. Amazon has ample liquidity with $15 billion in unused credit facilities plus $5 billion in short-term facilities. They terminated the secured credit facility backed by seller receivables. No concerns about financial flexibility here. Amazon invested heavily in Anthropic, the AI company behind Claude. From Q3 2023 through Q4 2024, Amazon put $5.3 billion into convertible notes. These converted to non-voting preferred stock in 2025. In Q2, Amazon invested another $1.3 billion. In Q4, they'll invest an additional $1.4 billion. In Q3, Amazon recorded a $7.2 billion upward adjustment reflecting observable price changes in the Anthropic investment. Total other income was $10.2 billion for the quarter, driven primarily by this Anthropic gain. For the 9 months, other income reached $14 billion. This investment could be transformational or a write-down risk. Time will tell. Net income reached $21.2 billion, up 38%. For 9 months, net income hit $56.5 billion, up 44%. Diluted earnings per share came in at $1.95, beating estimates. 9-month EPS reached $5.22. Net margin improved to 11.8% from 9.6%. But remember, other income from the Anthropic investment inflated these numbers significantly. Strip out the investment gains and core operational profitability tells a different story. Several concerns deserve attention. Free cash flow collapsed due to massive capital spending. This investment better pay off. Operating margins compressed in AWS, the most profitable segment. Technology and infrastructure costs are growing much faster than revenue. The 30% increase outpaces the 13% revenue growth. Stock-based compensation remains elevated at $15 billion for 9 months, representing 3% of revenue. The FTC settlement and severance charges show regulatory and operational pressures. Amazon faces ongoing antitrust investigations in multiple jurisdictions. The company changed server depreciation assumptions, which will continue pressuring margins. And AWS-growth, while strong at 20%, has competitors breathing down their necks. Amazon guided Q4 revenue between $206 and $213 billion. That represents 10 to 13% growth. Operating income is expected between $21 and $26 billion. Last year, Q4 operating income was $21.2 billion. The midpoint guidance implies modest improvement. Management expects foreign exchange to be a 190 basis point tailwind. Currency helps, but underlying growth remains in the low double digits. Capital expenditures will continue rising in 2025 and 2026. Amazon is all in on AI infrastructure. Amazon trades at a premium valuation compared to historical averages. The current setup reflects high expectations for AI monetization and AWS growth acceleration. The company is sacrificing near-term margins and free cash flow for long-term positioning. This strategy has worked before. AWS emerged from massive investment to become a profit engine. The question is whether AI infrastructure spending will generate similar returns. Amazon has execution capability, but competition is fierce. Microsoft, Google, and others are spending aggressively too. The market is pricing in success. Any stumbles could trigger multiple compression. Amazon delivered solid revenue growth across all segments. Operating income stayed flat due to one-time charges. The real story is the unprecedented infrastructure investment cycle. AWS margins compressed as Amazon builds for AI. Free cash flow turned sharply negative. The Anthropic investment added billions to other income. The business fundamentals remain strong, but Amazon is in heavy investment mode. Risks include execution on AI monetization, regulatory pressure, and competition. If you found this analysis helpful, subscribe for more earnings breakdowns. Remember, this material has a purely educational character and does not constitute investment advice. Do your own research before making any investment decision.